You can send a massive high-definition video across the globe in milliseconds, but try to move a single physical dollar across a border and the entire system grinds to a halt. Cross an international line with traditional currency and you are immediately hit with a multi-day waiting period, all while your funds are eaten away by compounding transaction fees. The delay happens because the legacy banking system is a fragmented chain of separate institutions. Every bank in that chain must independently verify, clear, and settle the transaction before the money actually arrives. The legacy financial plumbing is structurally incompatible with the speed and demands of the internet era. This mismatch created a vacuum that only technology could fill. Stablecoins like USDC emerged as the technological workaround, digital dollars designed to move at the speed of an email 24 hours a day. To maintain trust, these tokens follow a strict requirement. Every digital dollar issued must be backed one-to-one by a liquid, real-world asset. However, the early architecture had a hidden flaw. Because digital asset companies weren't legally recognized as banks, they deposited billions in reserve assets into legacy middlemen institutions. This reliance on third-party custodians introduced immense counterparty risk. If a middleman bank fails, the issuer is suddenly cut off from its own reserves. This structural gap kept stablecoins on the experimental fringes of finance, unable to fully integrate into the global economic bedrock. That gap is now closing. Circle recently received the green light to establish a federally regulated national trust bank, making them the first digital asset company in American history to receive a federal trust charter. This new entity, Circle National Trust, will not take consumer deposits or issue loans like a traditional checking account. It is a federally regulated custodian specifically designed to hold and protect digital assets. Securing this charter subjects the company to the most rigorous oversight standards in the world. Over the long run, this entity will oversee and manage reserves while offering institutional-grade custodial services beyond its own affiliates. Obtaining this charter officially pulls stablecoins out of the crypto Wild West and legitimizes them under the strictest framework of U.S. financial law. This shift rewires the underlying financial plumbing rather than simply moving assets between internal accounts. The charter allows the issuer to bypass legacy banks and directly manage its own stablecoin reserves. This direct connection manages a massive volume of assets, with over $73 billion currently in circulation. This middleman-free architecture eliminates the counterparty friction that plagued early crypto companies. This direct regulatory link establishes the issuer as a foundational pillar of the global financial system. The economic stakes are massive. Current projections show the stablecoin market cap growing to $1.45 trillion by 2035. This multi-trillion-dollar vacuum has triggered a competitive land grab from traditional financial heavyweights. New consortiums are forming to issue competing stablecoins, backed by legacy payment processors and major tech companies. They also face entrenched native crypto competitors who have historically dominated transaction volume. In a crowded war zone, holding a U.S. federal trust charter acts as an impenetrable competitive moat, offering institutional partners a level of legal certainty that rivals cannot replicate. This milestone acts as a catalyst for national legislative clarity that will officially treat stablecoins as cash equivalents. This clarity unlocks institutional-scale utility, enabling corporations and settlement banks to move value instantly, 24 hours a day. Securing this technology under federal law is critical for maintaining U.S. economic and national security leadership. This historic milestone proves stablecoins are the federally verified upgrade required to power the next generation of global commerce, the Internet of Value.